Kinder Morgan, one of the largest pipeline operators in the USA. 83,000 miles of pipelines, 40% of US gas transport, and stable dividends for 15 years. But is the stock overvalued in 2025, or is it still a safe dividend investment? Kinder Morgan is an energy infrastructure giant in North America. The focus is on natural gas pipelines and terminals. About 40% of US gas flows through Kinder Morgan. Additionally, oil and CO2 pipelines, terminals, and tanker fleets. Its greatest strength is a network effect and a monopolistic character. 83,000 miles of pipelines. Now let's take another look at my entry point. My entry was at €25.94. In total, I bought 4 shares. Currently, I am at an unrealized loss of minus 10%. That amounts to €10.86. I have already received a dividend of €2.55. With this stock as well, I definitely plan to make an additional purchase. Now let's take a look at the dividend growth. The 5-year dividend growth rate is 4.5%. The payout is made quarterly with a 3-year rate of 5.4%, as mentioned earlier, a 5-year rate of 4.5%, and a 10-year rate of minus 1.85%. Now let's take a look at the fundamental data using Investing Pro. You can find the affiliate link below in the video description. With my link, you get a 15% discount. The 52-week high and low range between 18 and 27 euros. Currently, we are at 23.18 euros. Analysts have set a target of 26.37 euros. The company is in a good position. The dividend yield is 4.27% with a payout ratio of 94%. We have 7 years of dividend growth. We have revenue for the last 12 months of $16 billion. We have EBITDA of $6.7 billion. We have a net profit of $2.7 billion. The EPS for the last 12 months, that is earnings per share, is $1.22. We currently have a PE ratio of 22.3, so it is rather highly valued at the moment. We have debt of $32.8 billion. The net debt to EBITDA ratio is around 3.9 to 4, so currently within the target range. We have a book value per share of 13.8. We have a credit rating of BBB+. The outlook is positive according to analysts from Fitch and Moody's. Just briefly, to return to the dividend. The current dividend is definitely covered. We have an operating cash flow of $5.6 billion compared to a dividend of $2.7 billion. Management is planning further annual increases, potentially more attractive if interest rates change. So, what about growth and projects? We have a project backlog of $9.3 billion, of which 50% is for increasing electricity demand, for example, data centers. We have the Cainthorpe project with $500 million. Then we have the Trident pipeline, $1.8 billion. Here, the capacity is to be increased from 1.5 to 2 trillion cubic feet per day. Then we have Texas Interstate Systems, which means increasing LNG deliveries. The Jones Act tanker fleet is operating at 100% capacity and is already 97% booked through 2027. The CEO forecast plus 28 trillion cubic feet per day in gas demand by 2030, of which 20 will be for LNG exports. LNG plus AI data centers are massive drivers for this. Here it states exactly what I have already mentioned. I'll just leave this up for a moment so you can read through it yourselves. So what are the opportunities? Gas boom until 2030, a bridge in the energy transition, increased electricity demand due to AI and data centers, more gas for power plants, and improved regulatory environment promotes faster approvals, tax advantages until 2028, hardly any tax burden, more free cash flow, credit upgrades, and greater financial flexibility. These were essentially the strengths here. Now let's move on to the weaknesses. The valuation is currently relatively high. The price to earnings ratio is 22, so it's currently valued on the higher side, meaning it's not cheap at the moment. Short-term liabilities exceed liquidity, which could lead to potential bottlenecks. The gathering volume is down 6% compared to the previous year and is sensitive to gas prices. The CO2 segment is declining, oil production is down 3%, and CO2 transport is down 8%. Analysts have lowered EPS forecasts more frequently over the past 90 days. Long-term risk, concentration on gas, danger of stranded assets in the event of a rapid energy transition. Here again are the opportunities and threats. Kinder Morgan is a conservative pipeline giant. 4% dividend, 15 years of history, stable cash flows, and a gigantic network. The growth story depends heavily on the gas and LNG boom. The opportunities are there, but the valuation is higher than that of many competitors. For income investors, Kinder Morgan is a solid but not spectacular dividend stock. And as always at the end, where do I find Kinder Morgan interesting again on the chart? So where would I consider buying more? Let's take a look at the data here, practically on the daily level. My potential buyback zones from the current value would be here at minus 29%, which corresponds to $19.75. Then at the 0.5 Fibonacci level, that would already be minus 39% at $16.98, and ideally at the 61.8 Fibonacci. That would currently be at minus 46%. At the moment, it's always difficult. Hard to imagine such large pullbacks. But we know October is near, and as we also know, that's usually the month when most stock prices correct. Those would be my buy the dip zones. I hope you enjoyed the video. Feel free to like the video and leave a comment as well. I'm also very interested in hearing other opinions. Let's just have a discussion about it. Otherwise, if you haven't subscribed yet, I would appreciate it if you did. I'm looking forward to the next video with you. Until then, happy investing.